Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, July 21st, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we do show futures are down, not a lot. We got the Dow futures down 86 points, S&P 500 futures down about 8, NASDAQ futures 1.25. So on a relative basis, NASDAQ futures holding up just a little bit better. Crude oil down nearly $5 a barrel this morning. We are back down to $95. Key support resides down around 93. We'll see whether or not we hold that, but that has been holding for the last several months. U.S. 10-year Treasury yield 306. So we're back up 2 basis points today. We're up a little bit yesterday. So definitely trending back to the upside. I think if we get through 311, we'll take a look at that chart just a little bit, but if we get through 311, I think we might have room to move back more to the upside. So that'll be worth keeping an eye on just to see whether or not traders are rotating into or out of bonds. Before we get started today, let's walk through the agenda. So for today, I'm going to go through the daily market recap, talking technically. The AD line versus the OBV. So if you're not familiar, accumulation distribution line, on balance volume, they're kind of the same, but I'm going to show you a chart that shows you why they're different. And then you can decide which one you prefer. For me, I like the AD line. I think it's better. And I think it gives us a little bit more of a feel for what's really taking place in the market rather than the OBV. But anyway, I'll go through and talk about both of them. Then we'll get into the earnings spotlight and wrap up with the 3 you must see. Before we get into any of that, though, I do want to take those of you, especially those of you that are new to the show, over to earningsbeats.com. If you come down, scroll down at earningsbeats.com, you'll find this area where you can sign up for our free newsletter. It's a 3 times a week newsletter published right at about 8:30 in the morning Eastern time, about an hour before the market opens. So you'll get that Monday, Wednesday, Friday. Normally it's, talking about gaps, relative strength, earnings, things that are really important to us, trend lines, moving averages, those types of things. We do have some folks like to trade these, some just use it for education. I do think everyone will find it somewhat educational. And in addition, if you are part of our Earnings Beats Digest community, when we do free events, we will invite you out. We'll give you the room instructions and all to come in and check out that free event. All it takes is a name and an email address. That's it. No credit card. You don't have to give your credit card information. You can unsubscribe at any time. So I think it's a great way to learn a little bit more about us and hopefully maybe develop some things for your own trading arsenal. Maybe it'll make you a little bit better trader. We'll see. Anyhow, just go in there, make sure you subscribe to that. Moving on to the daily market recap, another pretty good day on Wall Street. Definitely much better on the NASDAQ than it was, let's say, on the Dow Jones. But nonetheless, all of our major indices were higher. Dow Jones up 48 points, S&P 500 up 23, NASDAQ up 184 points. That was almost 1.6%, a full percentage point better than the S&P 500. Mid caps up over 1%, 24.5 points, and the small caps up 1.4%, almost 17 points. So small caps gained almost as much as the NASDAQ. So it's nice to see the more aggressive areas continuing to get money in this rally on a relative basis. I think that's very bullish. Leading from a sector perspective, this is what we want to see, these 3 right here: communication services, consumer discretionary, and technology. They all have broken now above their 50-day moving average, and they're gaining steam. The next key stop, next key area to watch on these groups going to be the early June high, at least on the technology, the XLK right here. That is going to be a big level. If you look back at the NASDAQ, same thing. We're moving up. I'd like to see the NASDAQ get up above about 12,400 or so. And we got about 500 more points to go to get there. But if we can break back out, I think that confirms the bottom call that I made back in June. I don't think it's been confirmed yet, but I believe if we take that out, because we had a series of lower lows and lower highs, and you don't really reverse that until you get through this high. Lower low, lower high, lower low. Long as you go up there and you don't take that out, you can still hang on to your bear market thesis if you want to. I like to call it a little bit earlier based on things that we saw in terms of rotation. But in terms of price action, pure price action, we've got to get up and clear the June high. So that's what you want to be looking at here on the NASDAQ, also on the S&P. I think that number on the S&P is around 4175. So we get up close to 4,200, we will be piercing that. Still got a couple hundred points to go there. Anyhow, these three sectors really looking much better. Their AD lines, talk about the AD versus OBV in just a bit, but their AD lines turning up, looks good. Utilities, well, utilities not putting in the higher, moves on the AD. You can see the last two highs right here. Tried to get through, but didn't quite make it. And we're trading below the 20, which is below the 50. So the setup here on the utility is not nearly as strong as we're seeing on these aggressive sectors. Same goes for healthcare. Healthcare lost about 1% on Wednesday. Healthcare also really struggling. It's kind of going sideways. Maybe look at this as some kind of a head and shoulder pattern, left shoulder neckline, head, right side of the neckline, right shoulder. I'd like to get up here and get through about 134 on the healthcare ETF before I'd be feeling a little bit better here. But it's not bad. AD line's really strong. And I'm not really thinking any bad things about healthcare. I just think right now we're consolidating, and I'd like to see a little bit more of a trend to the upside. All right, moving on to the 10-year Treasury yield. This is, let's get an update here. Right now, 304. Actually, we're still showing from yesterday on StockCharts, but I can tell you that right now we are at 3.056. So we are up 2 basis points. But I mentioned earlier, if we get through 311, we've already kind of broken the downtrend. I think, for looking, more intermediate term, I'm seeing more sideways consolidation, but short term, we were trending lower. And I just wanted to show you, if you connect those lows now, or excuse me, those highs, and kind of right in there, you can see that this sideways action and now today's action going up a couple more basis points kind of broken this downtrend. So it's a little bit like this, where we had a little downtrend in play. We broke it and we end up going to new high. Well, right now we're breaking it. Are we going to go to a new high? Well, if you're bearish the stock market, that's probably what you want to see. You want to see rates going higher. I don't know that we're going to go back up and take out that high. I think that may have been a peak, but hey, I could be wrong. If I'm wrong and rates go up, we're going to need to watch the stock market. Stock market could go back down again. Part of my thesis going forward here is that the stock market is likely to go higher because the Fed becomes more dovish. Now, of course, 10-year Treasury yield not exactly tied to those short-term rates, but if the Fed is turning more dovish, it means that it's not focused on inflation. And inflation does have a major impact on the long-term yields. I mean, anybody holding a 10-year Treasury yield is going to want to make sure that they're covering inflation, or they wouldn't want to own the 10-year Treasury yield. So you got to believe inflation is going to come back to the Fed's target level of 2% to be comfortable owning a 10-year Treasury yielding 3%. If you think inflation is going to be up at 6% or higher for an extended period of time, investors are going to demand higher returns. That's what will drive longer term rates higher. So part of this, if rates are going up, chances are, if it breaks out again, it's because of inflation expectations. So that's why I would be watching. That's the way I would interpret anyway, movement in the 10-year Treasury yield. All right. I did have a member ask me a question about the 10-year treasury yield. And when it comes down, isn't that good for banks? And normally going up is good for banks, not going down. It's really about the spread. So normally when the 10-year treasury yield is going up, I mean, if it's expectations about the economy getting stronger, that a lot of times will send yields higher. That's a good thing for banks. The problem was this rotation and this movement out of bonds, which was sending the yields higher, I believe was much more due to inflation than it was to the economy. I mean, it has little to do with economic expansion. I mean, we're looking at a potential recession. I think we're in one. So yields are going up not because of a strong economy. Yields are going up because of inflation. That's not a good reason for banks to make money. Banks make money when the economy is strengthening, yields go up. Because if the economy is strengthening, you're going to have fewer bad debts, fewer bad loans. So banks are more willing to lend money without fear of loan losses. So that's what you want. You want that strength in the economy. That's always going to be a better thing for banks than simply rates going up because of inflationary pressures. Completely different animal. I mean, if you got rates going up, but banks not willing to lend because the economy is weakening and we're in a recession, that's kind of a, double-edged sword there. I'd be a little careful. Just thinking rates go up, banks do well. So banks didn't do well when rates were going up. Normally you'd think, okay, when rates are coming down, banks would underperform. I don't expect that to be the case because I think as rates come down, I think it's going to be because inflation fears subside and it actually will help the economy rebound later this year. And that will be good for banks. So you do want to look at relationships because normally rising rates means good performance by banks, but that has not been the case this year because rates are rising for the wrong reasons. Really important. It always drives me crazy when people, look at the market and just say, this line's going up, this line should go down, or this line's going up, this other line should go up. You got to understand a little bit about what makes those lines go up and whether, that's good or bad for these various intermarket relationships. All right, let's move on. Talking technically, S&P 500, really, I mean, you can see we're now moving back up. I think the key, there are going to be a couple of keys here. First of all, that early June high, that's that 4175, 4180 area that I spoke about earlier. Got to go up and take that out. I actually think this is a move that we're going to trend higher and get to that level. I mean, this is a little bit tougher call, but we want to keep an eye on our sustainability ratios. I think they'll help us give us some clues as to whether or not we're going to continue to strengthen or whether we're going to roll over. And I'll talk about that in just a minute. But right now, we've taken out this double top right here. And watch that rise. The 20 days now is turning up. So now we have a rising 20-day. Here, when we broke out, see how we were holding it? And then once we lost the 20-day, things got a lot uglier. Can we hold the 20-day on weakness, number one? And number two, are we going to continue trending up? And can we clear the 4180 level to the upside? Those are the two things to watch, higher and lower. Now, one thing I talked about was the sustainability ratios. Look at the QQQ versus the spider. NASDAQ, normally in a bull market, the NASDAQ outperforms. That's what's happening right now. And it's been happening now for almost 2 months. Since the top, the beginning of the year, we haven't had this kind of a sustained move. The only period we had where the QQQ outperformed was right here. And I think a lot of that came during option expiration week when many of the NASDAQ components, NASDAQ 100 components were deep in the money puts. And so there was a lot of financial incentive for market makers for the QQQ, many of the stocks in the QQQ to rally. So anyway, I think this looks pretty good. I love the market going up, the AD line going up, and this ratio going up. I was concerned about the XLY, XLP, but that seemed to have held now, that prior low. I thought maybe, if we lost that, that would have been a little bit of definitely would have been a check mark in the bears column. But we didn't lose that. Now look what's happening. Now all of a sudden we're getting that money rotating into discretionary versus staples. A breakout above that early June high would confirm to me that we are heading back and maybe through that June high. So right now, sustainability ratios, AD lines, and even the technical price action looking much more bullish. Here's the NASDAQ. Now, this is the 1 month, 1 hour chart. And I just wanted to show you this top right here at just under 12.2. This top, just under 12.2. This top, just under 12.2, 12,200. We went through it. Volume expanded on that move going through it. Very positive action as we move up. Looks like the hourly PPO is turning up here. I still think we got room to the upside here on the NASDAQ. This is the NASDAQ 100. But, if we pull the daily chart up on this one, there's that early June high. That would be up at 12,892. So if you see 12,900 print, especially on a closing basis, that confirms that this downtrend has reversed and we're going higher. So now, I called the bottom. Don't have any confirmation yet. I have confirmation in some of the rotational signals. That's what suggested that I call the bottom. But in terms of price action, I don't have that confirmation yet. I get much more confirmation when we clear the June highs. That's what we need to see to the upside. All right, so let's move on. Let's talk about the AD line and on-balance volume. A lot of times these go the same direction. If we go, back 10 years and go to a weekly chart, if you look at them, AD lines going up, on-balance volume lines going up. They look pretty similar to me, right? Well, I think the AD line gives us a little bit better information. First of all, you can see that the on-balance volume of the spider, we're down to lows that we haven't seen since back in 2020. Looks horrible. AD line, we're not too far. Now this is a weekly AD line. The daily will show us a little bit different just because of the way they're calculated. But the weekly still looks a lot better. Now, if I went back and did a daily, you can see the AD line just keeps going up in this secular bull market. Look at all the false signals the OBV gives us. It broke down to a 1.5 year low down here. It was looking horrible. AD line barely pulled back, suggesting there was a lot of accumulation going on. Next thing you know, market goes back up again. Same thing with the pandemic. The OBV got crushed during the pandemic. That looked horrible. There was a little blip here on the AD line. That was it. And I said during that pandemic that Wall Street was accumulating while everybody else was selling. OBV doesn't tell us that. AD line does. And I've said this year, I believe we're in a cyclical bear market and we're going to go back up to all-time highs. OBV looks horrible. Still looks bad. AD line looks like weakness has been accumulated throughout this cyclical bear market. So let's shorten the chart, and I'll explain a little bit about what we have here with these two. All right. So the AD line, the problem with OBV is it takes, all it does is it looks to see Did you finish lower today than you finished yesterday? Or did you finish higher than you did yesterday? It doesn't matter how much you finish lower. It doesn't matter if you gap down and then came rallying back all day long. It doesn't matter how you got there. The OBV line goes up or down based on total volume and whether we went higher or lower for that day. Now, let me ask you a question. If you're sitting here on the spider and you're at, say, 400, and you gap down to 390, and you come back up and you finish at 399.75, do you think that's the same as gapping down from 400 to 399.75 and then selling off all day and finishing at 390? Because that's handled completely differently on the AD line. The OBV doesn't care. OBV, on balance volume, it doesn't matter which of those scenarios happens, the exact same volume is subtracted because you finished down for the day. It's very simple. We were at 400 yesterday. We closed at 399.75 today. It doesn't matter. Whatever the total volume is, we subtract it. The AD line, however, if you look at those two scenarios I gave you, where we're at 400 and one scenario is we gap down to 390, $10 gap down at the open, 2.5%. Futures are getting crushed. You gap down and then you rally all day long and you come back and you finish down just, 1/10 of 1%. I view that as a lot of accumulation taking place. I actually think that's a very bullish day. Gapping down and then coming back and rallying all day. The AD line loves that kind of behavior and it will go up. The OBV will go down. So let me ask you, if you see the spider go from 400, gap down to 390 and come back up and close at 399.75, do you think it's bullish or bearish? If you think it's bearish, then follow the OBV. If you think it's bullish, then you want to follow the AD line. The AD line, the volume is not just added in total. The volume is multiplied by a fraction. And that fraction is basically where did you finish today relative to your high and your low. If you gap down to 390 and went down to 385 intraday, and you came back up and closed at the high, all the volume for that day will be added. If you went down, let's say your trading range was 390 to 400, but then the end of the day, you went back down, closed at 395, you're right in the middle, there would be no change to your AD line because you finished right in the middle of your trading range. So that's the difference between these two. So when I look at this and I see the fact that we are now on a daily basis threatening to break out to a new high for 2022, while the stock market has done this, that tells me, well, at least it suggests to me that there's buying that's taking place. So the AD line to me is a better indicator. Like I said, when you look at the long term, these two tend to go hand in hand. But when you have differences, you've got to decide which one is more important to you. Look at these two red hollow candles right here. Both of these days, the reason that they're red hollow, they're hollow because you finish above the open. They're red, they're bordered in red because you finished down for the day. Even though you rallied from the open, you still finished down for the day. That's the example I was giving you. 400, you gap down to 390, you rally back to 399.75, you still finish down a quarter for the day. So you're going to get a hollow candle, but one that's outlined in red. If you're up for the day, you get a hollow candle outlined in black. Now look at these 2 days And look at the AD line goes up. Why? Because we're coming up and we're finishing, at least on the second day, we're finishing almost right on the high of the day. Both of these result in the OBV going down because we finished down for the day. Anyway, I just wanted to point that out. I think this is a good exercise in distinguishing between the two, and then you can decide what's most important to you. All right, earnings spotlight. Tesla, big one last night. So Tesla reported easy beat on the bottom line. I haven't looked at revenues on these stocks yet, but Tesla beat 227 versus 182. So nice beat on the bottom line. And the stock, when I looked earlier this morning, was up about 2.4% in pre-market. Got a lot of overhead resistance here around 760 to 780, maybe even 790. If Tesla can get back through 800, that would be a really bullish short-term sign. CSX, Railroad, they beat their estimate, bottom line estimate, 50 cents versus 47 cents, and up 4.25% this morning. Lots of hollow candles right in here. Look at that AD line moving up. I think we're going to get that gap up, but can we break through the 50-day on a closing basis? That's going to be key. Can we get through on a closing basis, or do we fail? All right, I tell you what, time for the three you must see. I'm going to do that, but I'll do it with three more earnings reports that came out. Here was one, XM. We did our earnings, Q2 earnings sneak preview last week, and this was one stock I said I did not trust. I don't think it's going to have a very good report. The reason I said it, first of all, the AD line is horrible. And look at the relative strength of this stock versus software. Software has already been down. Software has been pretty weak relative to the S&P. And XM is one of the worst performers in the software space. Wall Street doesn't like it. And you know what? We found out why this morning, or after the bell yesterday. They were expected to break even. They lost 4 cents. So they came up short on earnings. Stock down 3.5% pre-market. So not looking to break down, but not looking to break out, unfortunately, at least at the open. Next up, how about Alcoa, AA? Been trending lower. AD line's been moving lower. AA is basically the aluminum index, so you can't really look at that, in terms of relative strength. AA relative to the S&P, though, has been going down. They did beat 267 versus 260, and we are rallying up about 3.3% in pre-market. I think this one's got a shot to get back up in the low 50s. Maybe test the recent highs and then go from there. Last one is, we'll do KMI. This is Kinder Morgan. They just matched estimates, 27 cents. That's what Wall Street was looking for. Pre-market, the stock was only up about 0.5%. Got a little overhead resistance, gap resistance, and then the 50-day got price resistance over here. I think the stock could get up to 18, but beyond that, I would be really careful. I think that we now have a downtrend that we have to deal with. Anyway, that's it for me. I appreciate everybody tuning in. I'll be back with your next Trading Places Live on Monday of next week over at Earnings Beats. Everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.